Hello and welcome to this first video of the Counterpunch Trader. This is Troy Noonan, TJ from NetPicks, and we're really excited to start sharing the Counterpunch Trader with you. This has been a long journey getting to this point, and in this short video, which I'm calling Trading with the Wind at Our Back, 5 Pearls of Wisdom, the first in a 3-part series, I'd like to not only share how we got here, but more importantly, how to focus on the real knockout trades so that you too can ultimately rule the market. I'm not only going to share with you these 5 pearls, but I'm also going to show you ways that you can use them and implement them in your trading. So stay with me. I'll do my best to make it worth your while. So let's talk about these 5 pearls of wisdom for a moment, and then I'll go through each one and show you how we're going to use this information to make us better traders. Pearl number 1, learn to trade with the bigger trend while avoiding too much information. You see, a lot of people try to trade with the bigger trend. It's one of the oldest tricks in the book. But what usually happens is that people end up with that deer in the headlights syndrome. They are looking at too much information, and it can be confusing. One chart says this, one chart says that, conflicting indicators. This is so common. But I'm going to show you how we're going to solve that problem with one easy to read chart. Number 2, avoiding choppy price action. This is every trader's worst nightmare. Sometimes you can see it, but it could also start at any time. So we need to figure out a simple and effective way to avoid it as best we can. We'll never be able to completely avoid it. And to be successful, we really don't have to completely avoid it. We learn how to then mitigate it. Okay, so it's kind of a 2-part. There's 2 pearls in this oyster here. All right, but I'm going to talk about this in greater detail and give you some tips on how you can actually use this to your benefit, which leads me to the next pearl, learning how to anticipate the end of this choppy price action. These can lead to the best trades, and we want to be on top of it and know how to handle it and not get fooled by the head fakes that occur with the false breakouts. We want to be able to get in on the right breakout at the right time. And again, I'll show you some real easy things that you can apply to your charts that's going to help you get through the choppy action and then take advantage of what comes after. Because let's face it, markets trend and markets consolidate, and that is a repetitive pattern that happens on every single time frame. So we want to be able to take advantage of the trend, but be very cautious and avoid as much of the consolidation as we can, while also anticipating when that's going to end and the next trending move is going to happen. Okay, the next pearl is learning how to discover market exhaustion points. There's 2 important kinds. And it's this exact pearl is what the Counterpunch Trader is designed to do. I'm going to save the last pearl of wisdom as a surprise. It's the single most important indicator. You already have this indicator actually, but I'm going to show you how to use it to make you a real trader instead of just somebody trying to trade. There is a huge difference. And whether you're a day trader, swing trader, or a longer-term position trader, whether you prefer futures, forex, or stocks and options, these pearls will universally work for you. Trading looks easier than it actually is. But by applying these simple concepts, you can make it easier and be in a much better position to succeed. Have you ever tried spitting into the wind? Not too bright, right? Well, trading against the wind is even worse. We don't want to be this guy. I borrowed this next graphic from a book called Trading for Dummies. How apropos. It not only talks about how hard it is to succeed at trading and how most traders fail, but also it compares the success rate to some other things. Like, for example, training for a marathon. It's actually easier to train for a marathon than it is to day trade. Or what about opening up a restaurant? We all know how difficult restaurant work is. You have a much greater chance of succeeding, however, opening a restaurant. But as it says on the bottom, if you understand the risks and you keep them in perspective, you'll be better able to handle the slings and arrows of misfortune on the way to your goal. A losing trade is unfortunate, but it's a part of trading. But if you could utilize these pearls of wisdom in your own trading, you can minimize your losses, maximize your wins, and increase your chance of success as a trader. If you don't pay attention to these pearls of wisdom, you'll soon find yourself out of business. Let's choose to be this guy, which leads me to my first pearl of wisdom. Trade with the greater trend. But don't be roadkill. Too much information leads to this. And I guess this is as good a time as any to bring up the free indicator that we're giving away. It's called the High Trend Chop Indicator. If you haven't picked it up, you'll see it on this web page. Just click on the link and grab yourself one. It'll work on TradeStation, NinjaTrader, and MetaTrader 4. Now let's go to the charts. I want to show you how we use it with the Counterpunch Trader to help determine the higher time frame trend so that we can trade with that trend. I purposely left off the symbol and price information on this chart. Why? Because it just doesn't make any difference what it is. It could be a daily stock chart, a day trade futures chart like the Dow E-mini or the Russell or crude oil, or any time frame Forex chart. The same principle applies. I did put, however, an indicator on the bottom, the High Trend Chop Indicator, or the HT Chop. This indicator shows us the faster or more immediate trend on a higher time frame chart. But I don't have to look at the higher time frame chart. I actually have it right on the very chart that I'm interested in trading. This keeps things very simple and guards against too much information and ultimately becoming roadkill, like the deer frozen in the headlights. And to better illustrate this first pearl of wisdom, I think you can plainly see. Notice how the trend starts to move down when our high trend chop indicator is deep in the blue. That typically signifies an uptrend, and yet we want to go short here. These two lines are signal lines, the cyan and yellow line, and those show us a possible place where we may want to get short. Notice how it continues lower, lower, lower. Remember, this is happening on a higher time frame, more immediate trend, a fast trend. When you do trend study, you learn about near-term trends, intermediate trends, and long-term trends. What we're trying to do is trade with the immediate trend on the higher time frame chart, okay? But we've put that information on the chart we're interested in trading. Now notice that when it gets down to the bottom here, our signal line now begins to cross up. We caught the move from here down to here, you see? This indicator showed us this move. Of course, we have to team this up with a few other things. So I'm going to jump ahead and kind of give you a sneak peek at one of the other pearls, learning how to discover exhaustion points in the market by applying one of the tools from the Counterpunch Trader. These dots, they show us possible places where the price action has become exhausted. And so when we see that, based on some other rules of course, we want to come out swinging and attack with a big strong counterpunch. So imagine, if you will, the great boxer up against the ring, defending himself, rope-a-doping, Muhammad Ali, right? As soon as his opponent gets tired, he comes out swinging with a fury, knocks his opponent out. So when the market has moved up and exhausts itself, shown by these two dots, we then look for some confirming indication to come out swinging. And one of those is the HT chop indicator right there, see? All the way down. I'll talk more about that in a little while. And when I turn on the actual Counterpunch Trader, you're going to see that it did give us a setup right here. You can see the entry, various targets, the ability to take advantage of the greater time frame trend with the big move all the way down. That's how we take advantage and trade with the wind at our back. Here's a look at another example. This is the Euro currency futures, 233 tick. You can see how Counterpunch shows there's an exhaustion point and that we want to think about going short, especially when we look at our indicator down below and we see our signal line is crossed down and setting up a possible move to the downside. And remember, this is showing us what's happening on the faster trend of a higher time frame chart, trading with the bigger trend with the wind at our back. Notice that there are some other exhaustion points that this is showing us. Can we trade off of those as well? Well, we can, but that's also why this is a 3-video series. We'll get to that. Here's the same chart using the spot Forex Euro USD. Same principle applies. And here it is, the same Euro USD on a 5-minute chart. We have some exhaustion down here. Notice how we're trading with the higher trend going up right here and then the trend changes, takes us down. It works both directions, you see, all the way down to here. Trading with the greater trend while not becoming roadkill by too much information. One chart, easy to read, easy to trade off of. But there's another word in the high trend chop indicator, and that word is chop. That leads me to my next pearl of wisdom. Avoid choppy price action. But don't be afraid of it either. That only leads to roadkill. It's funny how our fears end up becoming self-fulfilling prophecies when trading. But the only profit we're interested in is spelled differently. And it begins by knowing how not to lose money, but how to hang on to it. Avoiding choppy price action is paramount to success. Remember, markets trend and markets consolidate. It's a pattern that continually plays itself out on every time frame. We don't want to find ourselves trading inside of this. Again, any old market, any old time frame. But this actually happens to be the Dow E-mini, the YM. And we like to start trading it when the US stock market opens at 9:30 Eastern Standard Time or 8:30 Central Standard Time, since the YM is traded out of Chicago. So imagine entering a session like this and seeing a chart pattern that looks like this. Do we want to trade inside of this choppy pattern, or is it better to avoid it? Luckily, we have our handy dandy HT chop indicator, which tells us by these dots down here below that we're in a choppy zone. So we have a heads up and we could stay clear. On the other hand, we don't want to be afraid of it because we know that great trades come out of choppy patterns. That's the next pearl of wisdom. Learn how to trade out of choppy price action. There are many ways to do this, but again, we don't need or want many ways. Too many ways only leads to, well, you know, we can't process too much information. We need simplicity. So let me show you one of my favorite tricks for trading out of choppy price consolidations. And it is very easy. We'll use the counterpunch trader to assist us, along with the high trend chop indicator. I've added a very common indicator to this chart. It's an exponential moving average, an EMA. It's a 50 EMA, and it gives us a great idea of where the price is likely to go. We also use our high trend chop indicator. We know from training that we're kind of in a choppy zone because of the signal lines being intertwined here going flat across the histogram, but we also know when the dots show up. Okay, so now we got to be careful. What we're really looking for is to watch the signal line and watch the price. Right now the price is above the 50 EMA, so we want to go long. Notice that the signal line crosses up and over, and it looks like the breakout is about to happen. It's staying with the higher trend and not fighting the 50 EMA. Now, how did we know to not go short here or short here? Well, that's where the counterpunch trader comes in, as well as smart trade plan rules. We know that we don't want to start trading this market prior to the open of the US session. So that automatically eliminates everything that comes before this line. But look what happens when we add the counterpunch trader. Now we see a whole myriad of trades. But remember, everything to the left of this line, we're not interested in. Notice right here at 8:30, there's a setup to go long. Let me move this line out of the way. How do we know? We've got the two dots here letting us know that the market has hit an exhaustion point. And then we get a setup here based on the rules of the strategy. And because we are trading above the 50 EMA, we can take a long trade, even though it's choppy, even though we're in a chop zone. Notice that here we're below the market and below the EMA, but the price never comes down to touch the entry. We don't have to worry about that. The rest is history. We'll be seeing a lot more examples like this as we take a closer look at the counterpunch over the next few videos. Let's take a look at one more example. This is the Euro-Yen. It's a 5-minute chart during the European session. And let's just pretend we entered the market and we want to start trading. Here we are at the right edge of the chart, and as we progress, we notice that not only did we trigger into a trade, but we just entered into a chop zone. Now, the fact that we entered into the trade above the 50 EMA histogram is blue, which doesn't always have to be, because we know that trends can come from below to up, like it did earlier here. Notice that the stop, which is this group of lines, it holds barely, but it holds nonetheless, and you're going to see that that happens a lot. Now there's a possibility to go short here, but we're not going to stop and reverse to short here, are we? Why? Because we're above the 50 EMA, and we're in the chop zone. We want to stay long. Turned into a pretty nice trade. It just barely missed that third target. But you could see there was a subsequent trade here that was also successful. Staying with the prevailing trend. Is there more to it? Are there other techniques? Yes, there are. And there are some other little things that we will do, some tricks that will help us even improve this technique. It's too much for the scope of this video, but we'll definitely be talking about it in great detail as we get more deeply involved with the counterpunch trader. Because avoiding chop and learning how to trade out of chop is something that the counterpunch trader does very, very well. Now, I've already mentioned this a few times, the fourth pearl of wisdom, and this is a very important one because it's what drives all of our successful trading, even if we're not aware of it. Of course, we want to be aware, and we want to know how to identify the exhaustion points. I've already talked about the boxer metaphor. Trading is the same way. We want to wait until the bulls are done buying before we take a short trade, and vice versa, right? I mean, it's common sense. At that point in time, when there are no more buyers, we want to come out attacking on the sell side. Of course, when the selling is dried up, we want to come out with a big counterpunch and go long. Basically, there are two primary types of market exhaustion. The first is what leads to the big reversal type of counter trend trade. We can see where the big exhaustion points exist on this Russell E-mini chart. Right here. Notice how counterpunch shows us this. Right here. Perhaps right here. When we're at the right edge of the chart, we really don't know. Perhaps right here. If we can get long after we've identified this low point, we're in for a great trade. If we can get short after identifying this high point, we're also in for a really great trade. The market has exhausted itself. There are no more sellers. Counterpunch trader, combining its rules for its particular setups, signaled the long trade right here for a real nice profitable trade. What about these other trades? What about all these other exhaustion points along the way? Well, that's the second type of exhaustion. It's the big exhaustion that gives us those reversal trades. It's the small exhaustion that gives us the continuation trades that follow the trend. Let's look at that chart again. It gives it to us here, 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 etc. And we also have a way of avoiding some of these trades that went the opposite direction that would have failed. But again, that's the subject matter of another video. Blowing up the left side of the chart, you can see how these trades go with the prevailing trend at the higher level. Notice the reversal long is where the higher trend is turning as well. And then we find the exhaustion points from which to set up high percentage trades. Both these types of exhaustion points on a chart are very important and lead to very successful trading. That's why it's so important to know where they are. And the counterpunch shows us very easily. In fact, that's how the counterpunch got its name. It waits for the exhaustion zones, shows us where they are, and then with the clever use of certain rules, it gives us trades with a high rate of success. It attacks with a big counterpunch. Now, I did promise you a fifth pearl of wisdom, but this video has gone on quite long enough, so I'm going to save it for the second video of this three-part series. I promise to deliver the goods. I'll even tell you what it is. The fifth pearl of wisdom is the single most important indicator, far more important than anything else. And best of all, you already have it. Be sure to be on the lookout for the second video, and we'll continue on with the fifth pearl of wisdom, as well as a deeper look at the counterpunch trader.